Topic A tonight, huge tax cuts, ultra easy money spells some mean stimulus. So will that stimulate stocks? That's the big question. How about the economy? How about commodities? We're going to look at it all this evening. Let's dive right in. We've got famed commodity investor Jim Rogers. He's the chairman of Rogers Holding Company. Barry Ritholtz, CEO of Fusion IQ. And Harry Rady. He's the CEO of Rady Asset Management. Barry Ritholtz, before I get to my old pal Jim Rogers, I want to ask you, Barry Ritholtz, I have been around for a while. I have never seen so much stimulus. We have ultra easy money pump priming from your friend Ben Bernanke, probably to the end of our lifetime. Now we have President Barack Obama, supply side or demand side tax cuts, supply side tax cuts. I've never seen so much stimulus. So my question to you is, will it stimulate stocks?
Well, sure. You know, anytime the old expression is give me $1 trillion and I'll throw you a hell of a party. That was said about the first Bush tax cuts. Now, not only do we have a 2-year extension of them, but we have the payroll, the FICA tax cut of 2%, which is mostly going to the middle class. It's under 100,000, primarily 106,000. We know that group of people tends to spend that money rather than save or invest it. So this is just so much more liquidity. At least over the short term, this is stimulative to the stock market. Absolutely.
All right. How stimulative, Barry? Just give me, give me a sense. How high are we going to go back to 14,000 on the Dow? What kind are we going to go back in on the S&P? The small cap stocks are almost back to the all-time highs. How stimulative? How high is the stock market going to go, Barry?
How high is high? Well, keep in mind that some of this is already factored into the market. You know, this wasn't a complete and total surprise, although I'll tell you, I didn't think everybody would agree to the payroll holiday the way they did. So I'd say about half of it is already factored in. We certainly have another 5 to 10% to the upside over the next 12 months, and then things have to be able to stand on their own 2 feet, which unfortunately, after a major credit crisis, history shows us that economies take a long time to heal, a long time to start creating jobs. So I think you're right. We're going to be looking at stimulus for the rest of our natural lifetimes.
All right, next of our natural lifetime, which I hope is a long natural lifetime for you, Jimmy Rogers. Good to see you back. I know you're a commodities man. Is this going to stimulate commodities, and will it stimulate stocks? Do you agree with Brother Ritholtz?
Well, first of all, Larry, I'm a little strange. I'm on a show with someone named Barry, Larry, and Harry. You know, what am I?
You're the odd man out, Jimmy.
I'm the odd man out here. I'm afraid to say anything. Larry, I don't know what's going to happen. If the economy gets better, you should own commodities because shortages are developing. If the world does not get better, if the economy doesn't get better, you should own commodities because they're going to print money. And whenever people have printed money, it has led to good things for silver, for rice, for natural gas, for real assets. So either way, the best way to play the world economy and the stock market is commodities.
Commodities. What kind of commodities? We've had a heck of a run in commodities, Jimmy. Is there anything that looks relatively cheap to you? I mean, gold near all-time high, silver near all-time high, oil's kind of creeping up to, what, $90? I got analysts talking $100. What specifically do you like, Jim Rogers?
Well, first of all, agriculture is historically the cheapest commodities right now, and I would say start with agriculture because that's where things are still very, very depressed. But you say, what's going on? Larry, your Princeton friend, Bernanke, is printing staggering amounts of money. And the man has the gall to say that there's no inflation out there. Please, this is going to lead to serious, serious problems for all of us. By the way, I'm also short government bonds because all this money printing is going to lead to serious problems.
All right, long commodities, short government bonds, Treasury rates actually creeping higher. Treasury rates all the way up to 3.12 today. Harry Rady, welcome back. Do you buy this euphoria, this mean stimulus we're talking about? I mean, this is the ultimate government pouring it on with some supply-side incentives, to be sure. Bernanke going to be easy money for the rest of our natural lifetimes. Harry, is there a glitch in this stimulating stock story?
Well, fortunately, I run a long-short fund, so I get to speak out of both sides of my mouth. So you know, look, this is really a real serious dichotomy. On the one hand, I would argue that valuations are significantly ahead of themselves. On the other hand, we've got the Bernanke put and QE2 and all these things that are pushing or backstopping the prices of stocks. So investors are rewarded for taking more and more risk and driving up prices. That said, going back to the commodity discussion, I have a bit of a counterintuitive way to take advantage of that. I would argue, I think that commodity prices will continue up, but I think that the prices of many of these stocks have already moved up significantly. So
you'd sell the commodity stocks and go long the commodities? Is that what you're saying?
No. I'd short the companies that will have a difficult time passing on higher input costs.
Okay, so give me a short. Give me a short. I like this short. Everyone else is long. Everyone on Wall Street is long. Give me a short.
Basically any of the restaurant stocks, any of the food manufacturers. Let's talk about a Cracker Barrel, a DineEquity. So lower-end restaurant stocks where, the bill is going to be less than, let's say, $15 a person, where the margin just isn't there. So as commodity prices rise, there just isn't enough room to pass it on. The margins are going to get squeezed. And these stocks are already trading at 52-week highs. So I think they're very vulnerable.
So there may be some problems there. Barry Ritholtz, do you agree with Jimmy Rogers' worries about inflation?
Well, eventually, yes. Right now, there are no signs of inflation like we saw in the 2000s where oil hit $1.50 and everything took off. But when you're printing money, you have to be concerned that down the road this becomes a problem. Right now, with 10% unemployment, tremendous capacity, underutilization, inflation isn't an immediate worry to me. But I share his concerns over the long haul. You can't just print money till the cows come home and not expect it to have a negative impact on prices.
I mean, the definition of inflation is too many dollars chasing too few goods. So
yeah, but aren't we going to produce more goods? Aren't we going to produce more goods? All right, I'm going to issue a challenge. I mean, you've got all these tax cuts. You've got low tax rates, historically low marginal tax rates on personal income, capital gains, dividends. You've got 100% cash expensing for new investment by business. Now, those are supposed to propel the production of more goods and services to meet the higher money supply.
We're already seeing it. First of all, let's go back to Barry. Barry is saying that that we don't have inflation. Barry, have you shopped anywhere recently? The price of everything is going up. Medical care, education, entertainment, tolls to New Jersey, cab fares, food, everything is going up.
It's not even a question. Look at commodity prices.
Well, medical care and education have been going up for decades. I'm looking at most of the purchases that are taking place on the corporate side and on consumers. The corporations are sitting with lots of cash. They're afraid to spend it. Consumers are still deleveraging. We have some price increases, but nowhere near the rate of price increases that we saw 03, 04, 05, 06. That was a very different situation.
Barry, what are you talking about? Cotton's at a 150-year high. Have you tried to buy any tin recently? Have you tried to buy any rubber recently? Have you tried to buy any cocoa?
The price of clothes have been free fall. The price of houses keep going down. A lot of stuff is just dropping in prices. I don't disagree with you. The first place we're going to see it is food and energy. That's the first place where it's going to take place. And we're starting to see some increases, but a lot of that has to do with a bad wheat crop, or some supply issues. We haven't seen the traditional too many dollars chasing too few goods inflation. I agree with you also. The dollar is going to get whacked, and that's going to elevate prices as well.
Hang on, Jimmy. Jimmy Rogers, let me ask you. Everybody is bearish on the dollar. The only problem with that scenario, and I acknowledge the Bernanke pump priming, he's going to create all these dollars. I know the whole world's against him. But if you look at year-on-year, 52-week changes, very interesting to me, Jimmy. I want to get your take. The dollar is actually up 6% over the last 52 weeks, even while gold is up over 20% and the whole CRB basket of commodities futures is up 15%. Jimmy, why is that? Are people too bearish on the dollar?
Well, Larry, I'm glad you brought that up. I actually own the dollar. Everybody's extremely pessimistic on the dollar, including me. But whenever everybody's on one side of the boat, you better go to the other side of the boat. So I own the dollar. I don't know how long I will own it, whether I own it another month or another year, I don't know. But everybody's too pessimistic, so I went long the dollar.
And Harry, I want to ask you, with everybody pessimistic about the dollar, and everyone's saying every time the dollar goes up, it's bad for the stock market. While the dollar has gone up 6% in the last 52 weeks, and while commodities have gone up, the stock market has gone up. I want to make that very clear. This idea that a higher dollar is bad for stocks is not borne out even over the medium term of 52 weeks, okay? The S&P is up 11% in the last 52 weeks. The S&P mid and small cap indexes are up nearly 30%. While the greenback is up 6%, Harry. The conventional wisdom can be wrong. The day traders can be wrong.
Yeah, absolutely. You know, look, we're opportunists. We're looking for opportunity, and we are contrarians. And where we see opportunity is in stocks that are out of favor. So the stocks that are overvalued and have gone up, I already described to you one place where we're seeing shorts. But on the long side, we think the opportunity is going to come in M&A. The economy will continue to be sluggish, and the way that companies are going to maintain their growth rates is by going out and acquiring companies. A good example will be in the drug and biotech space, in the defense space, which is trading at near 52-week lows, the oil and gas space, specifically natural gas. Natural gas is one commodity that hasn't caught fire yet, no pun intended. So it's trading at decade lows. These stocks are trading at 50% of their NAV, and we think M&A is about to go through the roof.
All right, on the way up, Barry Ritholtz, single favorite investment.
We like coal. We've been owning Arch Coal for a while. We continue to think the energy sector is going to borrow the pun, catch some fire. If the economy globally continues to expand, demand for energy is just going to keep going through the roof.
All right, great stuff, everybody. Thank you. Jim Rogers, wonderful to see you again. As always, Barry Ritholtz, thank you. Harry Rady, we appreciate it.